Outcomes-based investing offers a new way of thinking around investment strategy and can be particularly useful for clients who are approaching or in retirement. Here to tell us more about the outcomes-based movement is Standard Life Investments Director of Wholesale Business, Matt Newham. Matt, thanks for joining me.
Thanks, Sarah.
And can you tell us a bit about the origins of outcomes-based investing? How did it come about as a strategy?
Sure. Well, it's quite an interesting journey for us at Standard Life. So I think it was about 10 years ago that we were looking internally at a better way to manage our money in terms of our biggest client, which is Standard Life at the time. And we sort of, the genesis of the idea came about due to our pension plan. And what was happening with our internal pension plan was around 2005 and 6, it was underwater, it was in deficit, it was underfunded. And to that point, we generally used a standard traditional balanced portfolio of equities and bonds. And what we've known for a long time is that those sort of portfolios aren't truly diversified. Even if you have 40 or 50% of equities in the portfolio, the risk of the portfolio, 90% of the risk is to do with equities. So from that starting point, we went to the trustees of the Standard Life pension plan and we said to them, what about if we threw out the idea of a typical balance fund, and we had a clean plate, started with a blank canvas and built something from there. So what we did then was we went away and we looked at what is that the pension plan really wanted to. And what, of course, like all investors, they want good returns, but they also want to limit the risk of their portfolios. So we built what we would call, and what is now known as, an outcome-based portfolio. An outcome-based portfolio really is an unconstrained portfolio in terms of what it can invest in, but what it is constrained in is the risk side of the portfolio. So Standard Life built an outcome-based portfolio, which today is known as our Global Absolute Return Strategies Fund, or GARS. So when the GARS fund was built, we went to the trustees and said, look, we think we've built you a better fund, a better portfolio. They came on the journey with the investment team about what it was that we were trying to build. And there was a few parameters around what we were trying to build, even though it was unconstrained. And those parameters were that the fund had to be liquid, so all the strategies in the fund had to be liquid. The fund had to be transparent for the trustees, so the trustees knew exactly what we were investing in. And the fund had to be truly diversified in terms of the amount of strategies, so there was no risk skewing it to maybe equities or bonds or so forth. And importantly, that diversification needed to be measured independently, and we can do that. And then finally, and the big thing with outcome-based is we wanted to be able to deliver the same amount or similar type returns as equities, but with a much lower volatility. And in the case of our GARS fund, or the fund we use for our pension plan, that volatility is between half to a third of equity market volatility. So at the time, and over that journey, the trustees decided that yes, it was a good way to invest. We invested, we went from the balance fund to the outcomes-based fund. It was around 95% of the whole pension plan, so not a small amount, and the other part was just a few liquid assets. And since that inception of 2005 in our pension plan, it's done extremely well. The GFC in 2008, our UK pension plan was the best performing pension plan in the UK by a long margin. And I think what that sort of highlighted at the time to other pension plans, especially in the UK, was there is a better way to manage money. We offered our GARS fund to external clients around sort of 2007 and 8, and since then it's been a really successful fund. So internally for our pension plan and for external clients that are also using it.
And how can it help advisors in the current market, particularly those with a lot of retiree or pre-retiree clients?
Yeah, so I think, you know, the outcome-based investing is a relatively new concept for a lot of the market, especially the retail market. But what it really offers is, and it goes back to the point before, that your normal balance fund, which is equities, bonds and some property, the bulk of that risk is still from the equity part of the portfolio. So as you're hitting or close to retirement, you've got that variability of returns because equity markets are volatile, and also the sequencing risk involved in that pre-retirement and post-retirement area where you're maybe not contributing as much as you have been. So if you take that into account, where an outcome-based portfolio is probably best used is towards that part where you are getting towards retirement and after retirement. And what it does is it tries to generate similar returns to equities, but because it is very risk controlled, you are not going to get the losses or the drawdowns that you are going to get by investing in a normal balanced portfolio. So we believe for retirees and people approaching retirement, it allows you to continue to have a growth focus in your portfolio, but knowing that the returns are going to be a bit smoother along the way. You're not going to have the big ups and downs and drawdowns. So that it's really a smoother journey for retirees. And we find in our home market, the UK, it's very popular, and I think in Australia, as the market becomes more educated, it will start to become used more for retirees.
And how long has Standard Life been offering this strategy in Australia, and what has the reception been like with advisors so far?
Yeah, so initially it was about 6 years ago we started offering the strategies, the outcome-based strategies, to the institutional market where the take-up has been quite strong. And what we found was a number of the trustees on the superannuation boards and some of the internal researchers said to us, well, how can I personally invest in these type of strategies? So probably 3 years ago, we offered it into the retail market through an Australian trust. And since that time, we're getting some really good interest. It's still very early days for these type of strategies, but to date, we're really happy and pleased with the amount of take-up.
And where does it fit in terms of the typical retiree portfolio? What kind of allocation would you recommend?
Yeah, so interestingly, when we first offered the fund in the UK, we found that it is an equity-like fund. It's trying to return equity-like returns. So we would say that you would allocate from your equity part of your portfolio into outcome-based investing. I think the one important point to note, though, is you can have quite a large allocation to these type of funds because they are risk controlled. If you think about some other alternative strategies, you probably only want smaller amounts in your portfolio because they're riskier and higher volatility. Outcome-based investing, you can have quite a significant and meaningful exposure to them, knowing that there is that risk control to it.
And are there any risks or downsides that advisors need to consider if they're thinking about using this type of strategy?
Yeah, sure. Probably wouldn't say risk, but I think what people that use these strategies need to be aware of is that they're looking for a specific type of return with a low risk as possible. So the only sort of thing that you must be aware of is why you're using this type of fund. And to give you an example, our GARS fund is a cash plus 5 objective. Now, that's what we're trying to achieve. The risk may be if equity markets do 25%, for instance, 1 year, we aren't going to deliver those type of returns. It's not what we're trying to do. So it's just a matter of being aware of why you're using this type of fund and what sort of return you're trying to get out of it.
And what kind of role do you see this type of strategy playing in advice client portfolios as the market evolves?
Yeah, so once again, I think it's very early days for these type of strategies in the market. The good thing is there is more, I guess, other fund managers coming to the market with similar type strategies. So we see that as a really good endorsement of these type of strategies. And I think, once again, it's really about getting a decent allocation to it, understanding what you're trying to achieve by allocating to an outcome-based return, and really understanding how these funds may differ from fund manager to fund manager, and just being aware of those type of things.
Great, Matt, thanks for your time today.
Thanks, Sarah. Cheers.